Okay, so the next step we take is we've done a practice and a basic 1040 return. Now we're moving into the land of an intermediate return. Now I'm going to show you some information today that's from the old Form 1040A, which again disappeared with the 2018 tax table. But the key difference here with our example is we are adding a dependent, which some of you're like 17, 18 years old. You're thinking, I'm single and this is like years away. And if you're going to be like me, I remember in the winter of 1988, when I was 26 years old, waking up in the middle of the night and going, oh my goodness, I'm married. I have a kid and I have a mortgage. I got a loan on my house. And all of a sudden, I'm wearing the big boy pants and I'm an adult. So these things may happen faster than what you realize. Okay, so let's dive in here. First of all, a couple of sample questions. By the way, this is from my old financial algebra class at Walla Walla High School. First of all, and we've talked about this in our insurance unit, tax deferred. What does that mean for starters? You'll never have to pay tax. You'll eventually pay tax. You'll have to pay tax now. None of the above. Tax deferred means you will eventually have to pay tax at a later date. Now, this applies to particularly what? Pause for a moment. What kind of situation does this apply to? Probably the money taken out of your 401k or an individual retirement account where it's being taken out pre-tax or it's being deducted and reducing your taxable income. But later on, in future years, when you pull that money out, you're going to be taxed on it. Tax deferred. Remember, tax-free, like the HSA, the FSA, health insurance premiums, you never pay money on that on that income that was reduced down to your taxable income. Kate is filling out her income tax return. Her tax for last year is $973. Remember, that's her tax burden or her tax bill, if you like. Her employer withheld $712 in federal deposits. That's her withholding for how much she's actually paid. Well, if she's got a bill for $973 and she's paid $712, you can probably see that she hasn't paid her entire bill, correct? Through her withholding with her employer. Does Kate get a refund? Does she owe the government money? Question number one. Well, I think you can see that she owes the government money. What is the difference between Kate's tax and the amount withheld by her employer? Simple math problem. That would be $261 that she owes in addition to the government when she fills in her return. Now, you're probably wondering, oh my goodness, what happens if I don't estimate right and I have to pay? Well, unless you estimate very poorly on your W-4, remember, before you start working, you give to your employer. If you end up at the end of the year having to pay, hopefully you've got some money set aside to make up for that difference, number one. Number two is if you're in a reasonably close proximity to what your bill is, you're okay. If you're like way, way off, you may have to pay penalties and interest, but that's a pretty extreme circumstance. And of course, you would want to go back to your employer and go, here's a new W-4 with some different withholding allowances. So you'll take more money out of my check this next year. Because again, your goal is to zero up. You want that tax burden to equal your tax bill, your tax burden to equal your tax withholding for how much you've paid through employer deductions. So in this case, Kate's got to pay $261. So we're going to dive into an example here. Now, this is using the old 1040A, so disclaimer, not used anymore. But it's kind of getting into a little bit more advanced of a tax return, just so you understand how these work. Because later on, you're going to be doing your own, maybe even this year working, you never know. They have two W-2 forms. Remember, that's what you get at the end of the year, your wage and tax statement from your employer. Plus, they had $987 on bank deposits and $1,200 in stock dividends. Remember what stock dividends are? Pause for a moment. Think, what are stock dividends? What are those? Why are those taxable? Okay. Hopefully you remember that from our investment unit. Here is W-2 number 1 for Robin. She has some wages and some federal withholding and blah, blah, blah there. And then here's the one from Kenya Omar, who had a job at the hospital. The other one was department store. And he had wages of $52,000 and some withholding of $6,100 plus change. So I'm looking at the federal withholding for Robin and the federal withholding for Kenya. The wages for the two of them and the federal withholding for the two of them, primarily. Okay. So we're going to start putting their return together. How many exemptions can they claim? Again, this is the old form, disclaimer. They have themselves and they have a son named Robert. So they're going to end up having 3 withholding exemptions. Okay. And we're going to do a practice return related to this as well here afterwards. Determine the Omar's adjusted gross income. Again, they had the 987 bank interest, deposits, 1,200 stock dividends. And once again, we're showing their W-2s again. And here we go. So if we add up the income, 65,000 plus 52,000, those two numbers, we end up with, again, rounding to the nearest dollar, 117,248 in wages, salaries, and tips. Taxable interest, 987, and ordinary dividends, $1,200. Total down here, 119,000. No adjustments to income. Adjusted gross income, 119, which really, after their standard deduction. Now, here's their standard deduction. This is really dated. I think the one we're going to use today is 24,800. Don't worry so much about the numbers, just the technique. We have to drop in whatever the current year's standard deduction is for the Omars. So I'm just going to keep that number there for now, just for demonstration purposes. We come down here, and their taxable income ends up being 108,535. They got an additional 10,500. Again, this would be part of the new standard deduction. So this line 26 doesn't really exist anymore. Bottom line is we come down to a taxable income in kind of different methodology, down to 98,035 taxable income, line 27 on this old 1048 form. Okay. The tax on that, using the tax tables of that time, I'm not going to update this every year for the presentation. The tax on that's going to be 17,194. Okay. And we're going to come down to the big difference being with the new 1040, you get $2,000 for every kid less than who's 17-year-old or less, plus you get an additional $500 for any other dependents who are over that age, or maybe you have a parent living with you, you're supporting them, get $500 for them. And these are tax credits. Now, you have taxable income, you have tax credits. What in the heck is a tax credit? That's a dollar for dollar reduction of your income tax. It's like a free rebate or a payment that the government's making for you on your taxes. They're saying, hey, if you have a kid, we're going to give you an additional $2,000 right off the bat. If you have 3 kids, we're going to give you $6,000 and so on. So you're reducing the amount of tax you have to pay. So a tax credit is a dollar for dollar reduction. When you reduce your taxable income, that's just reducing the amount of income that's going into that calculation. That's not a dollar for dollar reduction. You still are applying some sort of a percentage to that taxable income. The tax credit, it's like right off the top. So if we take $2,000 right off the top, and you can see I've probably adjusted some of these numbers, we're reducing our tax from $17,194 by the $2,000 child tax credit down to $15,194. And when we add those lines together, we come down here and our total tax is $15,194. And again, when we get to the 1040, there's going to be a lot of blank lines on that form. So I'm kind of combining the old and the new there, so apologize to that. This is how they show us on the tax table how we got to that initial $17,194. This is, of course, an old tax table. Okay? Determine the Omar's tax for the year. So we come down here, $15,194. We add up the two amounts from the W-2. And we're like, where did $14,965 come from? Let's go back briefly here. That came from here. We add up 8765.99 from Robin's return for federal income tax withheld. And we come over here to Kenya's W-2. He had 6,198.65. We add those two numbers together, round to the nearest dollar. And so their tax withholding or their tax payment was $14,965. Now remember, their net bill after that child tax credit is $15,194. And you can see that, their bill was a little bit more than what their payments were. Yeah, down here by line 47, by $229. That's pretty close. I got a little bit of a typo there. It's kind of messed up there, but the bottom line is, just ignore that. $229 they have to pay an additional amount to the government. Now, they came really close. I'm not even sure if they want even to adjust their taxes for the next year, their W-4. On $15,000 of tax being off by $229, as long as you've got that money sitting around ready to send to the government, you might want to wait until April 15th to make your last payment when your tax return is due. That's pretty close. So they end up having to owe $229. Okay, so there's our return for the Omars. And after this, we're going to do a little practice on a 1040 with a little bit more of a twist than our original one. And take care. Enjoy your day.